Yeah, the market's acting exactly as we predicted here on TradeSmith. I hope you're enjoying the perfection here of our predictions. And of course, I hope you appreciate the perfection of this disclaimer. Live it, love it. Well, whatever. Okay. Listen, this market's been dribbling lower. You know I've been nervous. I've been calling for lower prices. I've been saying maybe 3 to 5% correction, something like that. Well, we're on track for that. You can see the market sold off most of last week, and in particular on Friday, closed on the lows, which suggests that we're going to continue lower at least early on Monday. But look at the purple predictor. I've been highlighting this now for almost a month. It's calling for lower prices. There's only a few bullish factors and lots of bearish factors. Now, let's be clear. I'm not calling for a crash. I'm looking for a correction. That's all. Let's say 5%, give or take a couple percent. No big deal. Now, let's take a look at the Dow Jones. Our ADX indicator up at the top, it's turned bearish. Then let's look at, that's the top arrow there, the red arrow. Then let's look at the second red arrow there. Look at that. We're cracking down here. I mean, that's a bear market. I mean, a bear market in that we're making lower lows and lower highs. So the Dow looks pretty crappy. Even over here on the NASDAQ, which had been going sideways, and we'd have to officially still call it a sideways market. But man, those are a lot of red bars over the last couple of weeks. And in our technique that we call every bar tells a story, this is telling us that this is shifted into a bear mode or correction mode. So this thing looks like a piece of garbage. I still look for the NASDAQ to outperform because look at the purple predictor. It's doing fine. It's okay. It's not bullish, it's not bearish, but it's telling us that this is not a particularly good market either. Better than the others, but not particularly good. Now, seasonality, look at this. We've been talking about this. We got down about 3 weeks ago right to the breakdown level. We then rallied up, but our rally was feeble. Then we dipped a week and a half ago. We didn't get down to the bottom of the range, and then we tried to challenge moving up, but we didn't do that. We failed on the upside. So we cracked back down, and given the very sharply bearish price action of Thursday and Friday, I would look for this to go down to that to our horizontal or nearly horizontal line at just over 132. Let's call it 132 and a half. But I got to tell you, this sure smells like it's going to break through and turn our seasonality indicator bearish. Now, when that happens, I'm going to have to go to half size risk. All my positions that I buy, I'm only going to put on half size, whereas I have been at double size up until now, which has really helped us outperform the market dramatically. Seasonality. Now here you can see we're in the middle of April, and the seasonality in late April has a little teeny dip, but then rallies right back up to make highs in mid-May. That seems perfectly reasonable. We take a little dip right now, 3, 4, 5%, something like that. No big deal, ain't no thing. Then it turns around and rallies up and makes another high in May, and then we start to suffer more like 5 to 10%. All right, so follow that scenario. All right, the yield curve. I want to go into this a little bit more detail. This predicts the market a year in advance when it is at extremes. Now, it's not at an extreme right now, so the impact of the yield curve is not as strong. And you can see that over the last couple of months, the yield curve has been going up, which is bullish for the stock market. But notice what's coming up here in May. A year ago, the yield curve collapsed from 165 down to just about 110. Now, that's not enough to signal a bear market, but it's coinciding with telling us that it's going to be very difficult to rally. And so combine that with the seasonality tells me that, starting in the middle of May, going through June, we could have a pretty rocky time in May, June, July, something like that. Then after that, the seasonality turns a bit more bullish. And in addition, we see the yield curve starts to widen back up, and that'll be a positive effect on the stock market. Asset allocation is turning. this is part of the reason I've been bearish recently, is we're seeing money flow out of the stock market and into the bond market. And we're talking about billions and billions and tens of billions of dollars. So this is not a trivial factor. Stock market risk indicators still, they want to hunker down. They don't want to take a lot of risk right now, and that's not bullish for the stock market. Global shares also sharing in the pain, a little dip, which is all I'm looking for here. All right, bonds. Now, I told you that we were seeing money flow out, and I talked last week. I said if we break through those highs, then this could go up much higher. And that's exactly what happened. We're seeing money flow out of the stock market. We're seeing a flight to quality. People are hunkering down. They're saying, oh my God, this stock market looks terrible. All those things we thought Trump was going to do, he's not doing them as fast as we wanted to. And holy moly, he might not be able to get through some of them at all. Tax reform, repeal Obamacare, etc., etc. And oh, by the way, we might be going to war with North Korea. So you know what we need to do? The market is saying we need to hunker down. We need to buy some bonds. We need to sell some stocks. We need to buy utilities. We need to buy consumer staples, defensive stocks, things like that. Fully paid up members, you'll see we're going to be buying those when we get to the fully paid up section. But nonetheless, these bonds are going up to 127 in that range, 127, 128. That's a pretty big move here. That's $3,000 in the futures contract. So look for bonds to continue to move higher. Now, our bond factors, though, are pretty much neutral here. One bullish, one neutral, one bearish. But if bonds are going down, that means interest rates are going down, which means that the dollar will probably go down. So we got up, just as I told you, we got up to that downtrend line. We've sold off. I think we're going to go lower. I still think the fundamentals are very, very strong for the dollar, but I don't fight the market. And right now, the market's telling us we don't want to be in the dollar. So you know what? Whatever the market tells me to do, that's what I do. So look for the dollar to weaken. Now, as you know, if the dollar weakens, that means gold goes up. Now, last week I told you if it breaks above that horizontal green line, we got to get long. Got to be long now. Don't want to be strong, but we've got to be long. So let's have a smaller than normal position, but you should be long gold at this point. Now, gold indicators have turned bullish in general. We've got one that's neutral, but two that are bullish, which is spectacular. That's one of the more bullish situations we've been in for quite a few months. We haven't really had a bullish fundamentals picture for gold, but now we're starting to turn that way. Oil, this is going to turn around and go down. We're not going to break through that horizontal or near horizontal purple line. We are going to sniff it out, which we did this week, and then I think we're going to head back down. We're just seeing a flood of new oil come into the market. Demand's not going up. It's starting to fade. And so look for oil to peel over and start to go lower. Hey, freebies, love having you here. But of course, if you want to be with the cool kids, you should sign up and pay for a subscription to get to see what the cool kids are doing, all right? Fully paid up members, hang in there just a second. And we got a couple new trades and some pretty exciting stuff. So hang in there.